Welcome back to the deep dive. So you sent us a fantastic stack of sources covering one of the most vital and, let's be honest, often confusing elements of personal finance, life insurance.
It really is.
And for most people, this decision, I mean, it means committing to payments for decades, so you really need to be sure you're spending your money wisely.
That's absolutely right. And our mission today is to, cut through all the jargon and the sales pitches. We're going straight to the core of this by focusing on two essential questions.
Okay.
First, is life insurance actually an investment, and how do the numbers, how do they really stack up? And second, what does that deeply intrusive application process actually entail?
And what power do you have to influence your premium?
Exactly.
We're going to define the two big categories, that's term and permanent, and walk through a specific financial showdown that I think will create a major aha moment for now. And then we'll dive into the practical steps, what you need to do to qualify, including why honesty and even your old speeding tickets can affect your rate.
And understanding this is really a shortcut. It helps you recognize the true purpose of the policy you're buying. Are you buying protection, or are you buying a financial product? We want you to walk away with the facts you need to decide.
Okay, let's start by defining the battlefield, so to speak. The sources all emphasize that deciding if life insurance is a smart investment, it depends entirely on what you need it to do.
And for how long? That's the other key piece. We're talking about two fundamentally different instruments here.
Yep.
First, you have term life insurance. And, like the name implies, it covers you for a set period, maybe 10, 20, or 30 years.
So it's kind of like car insurance.
It functions exactly like car or homeowner's insurance. You pay the premium, and if the event your death happens during that term, a benefit is paid out. The goal is just financial security for loved ones who are losing your income.
And then there's permanent life insurance, which is where things start to get a lot more complicated.
A lot more complicated. Permanent life is designed to cover you for your entire life as long as you keep paying the premiums. And the crucial part is that certain types, like whole life, include a cash value component.
And that cash value grows tax-deferred.
It does. And it's this component, the part you can invest and borrow against, that agents are talking about when they pitch life insurance as an investment.
The cost difference, though, that was the first thing that jumped out at me from the sources. They're very clear that term life premiums are typically way less expensive.
Far less. And that's because the insurance company is taking on less risk. They know exactly when their obligation to you is scheduled to end.
And that certainty for them means a lower cost for you.
It does. And that lower cost is really the first and maybe the most significant advantage of term life.
So let's focus on term for a minute, the essential safety net. What else makes it the go-to choice for simple income replacement?
Well, beyond the lower premium, which is huge, it offers incredible flexibility. You get to choose a term length that precisely matches your financial obligations.
Like your mortgage, or until the kids are out of college.
Exactly. You have, say, 15 years left on your mortgage, and your youngest will be independent in about 18 years. So you might choose a 20-year term policy to cover both of those liabilities. Simple as that.
I found the source material's take on the return on investment, or ROI, really insightful here.
It's almost more of a philosophical point, isn't it?
Yeah, that is.
Term provides an incomparable return on investment, but only if the worst happens and the benefit is claimed. You pay $10,000 in premiums, your family gets $1 million. The ROI is massive.
But if you outlive the policy, which is what everyone wants to do,
Then it's a negative return.
yeah.
You paid for peace of mind and protection that, thankfully, you didn't end up needing to use. And that's a good outcome, even if the ledger shows $0 back.
And I did notice the sources mentioned that a lot of term policies offer an option to convert to a permanent one later on. It's expensive, but it's there.
Yeah. It's kind of a safety valve, yeah.
Yeah.
But we should be clear. The main drawback of term is its simplicity. If you outlive it, it lapses. You get nothing back. There's no cash value.
Okay, so this is where it gets really interesting. Let's shift to permanent policies, which offer features way beyond just the death benefit.
They do. And this is where you really need to put your critical thinking hat on. The sources are quick to caution that, a lot of these touted benefits, you can get them elsewhere.
In dedicated retirement accounts.
Exactly. In 401ks or IRAs, often without the drag of high internal fees and the steep agent commissions that these permanent policies carry.
So walk us through those advantages, starting with the cash component.
Okay, first is the tax-deferred growth. The cash value grows over time without you paying taxes on it annually, which is just like how funds grow in a 401k.
And the second big one,
Lifetime coverage. And this is genuinely crucial for some people. We're talking high net worth individuals doing estate planning, or maybe if you have a dependent who will need financial support indefinitely, like a child with special needs.
And what about accessing that cash? That's a huge selling point you always hear.
That's the third point. Access to cash.
Yeah.
You can borrow against that cash value for a down payment on a house, college tuition, whatever. And unlike a 401k, there are often no early withdrawal penalties.
But, and this feels like a huge but.
It is a massive caveat.
Yeah.
When you borrow against the cash value, you are directly reducing the death benefit that your beneficiaries will get. You are, in essence, borrowing from your own legacy.
So if you die before you pay it back, that debt just gets subtracted from the payout.
That's the trade-off. And the fourth benefit is something called an accelerated benefits rider. This lets you access a chunk of the death benefit, maybe 25% to 100% early, if you get diagnosed with a critical or terminal illness.
Which is a great feature, but the sources point out that a lot of term policies offer that now too.
They do. It used to be unique to permanent policies, but now you can often add it to a term policy as a pretty affordable rider.
Okay, let's really hammer home the disadvantages, because this is what sets up the financial showdown. The high cost is obvious, but why are they so high?
It all comes down to fees. The sources explain that the commission paid to an agent on a whole life policy can be, well, staggering. We're talking 50 to 100% of your entire first year's premium.
The entire first year's premium.
The whole thing.
Yeah.
And that money is taken right out of what would otherwise be building your cash value. It means for the first few years, maybe 5 years or more, very little of your payment is actually growing for you.
It's just paying off the administrative and commission costs?
Exactly. It creates this massive lag before you see any meaningful accumulation.
And that structural problem really undermines the whole investment argument for the average person.
Yeah.
So let's look at the numbers. This is the part that, for me, was the big aha moment.
Let's run this scenario right from the source material. We're looking at a healthy, 30-year-old, non-smoking woman. She wants $1 million in coverage for a 20-year period.
Okay, so option one is term life. That $1 million of coverage costs her about $440 a year. Over 20 years, her total spend is $8,360.
Right. It's predictable, it's low cost, and it gives maximum protection during her peak earning years.
Now for option two, the permanent or whole life policy.
For that same $1 million in coverage, she would be paying approximately $9,612 annually.
Wow. Oh.
Over 20 years, her total premiums paid are $187,400. And after those 2 decades, the guaranteed cash value of that policy is only $181,630.
Wait, hold on. She paid in almost $188,000, and the guaranteed value is less than what she put in.
It is. The fees and commissions literally devoured her return and then some. The numbers just lay bare the structural inefficiency.
So now we get to that classic buy term and invest the difference idea.
Let's run that calculation. The difference in the annual premium, the money she saved by choosing term, is $8,890.
Okay, so if she takes that extra money, that $8,900, and invests it every year in a pretty standard diversified retirement account, let's say it gets an 8% average return.
Which is a very common scenario. After 20 years, the total amount she'd have pre-tax would be $421,064.
$421,000. That's more than double the cash value in the permanent policy. That alone just makes the case.
But here's the real crucial detail for anyone who says, well, the market is risky and whole life is guaranteed.
Right.
Even if she had taken that extra money and just put it in a basic, low-risk savings account earning only 1% interest, she would still have $196,425 after 20 years.
Which is still more than the permanent policy's guaranteed value. Still more. So the takeaway is crystal clear. For the average person, buying term and investing the difference isn't just theoretically better, it is numerically superior, even under the most conservative assumptions.
So we're talking about insurance as income replacement, not wealth creation.
Exactly. The permanent policies only really start to make sense for very high net worth individuals dealing with complex estate tax strategies that they don't apply to 95% of people.
Okay, shifting gears now to the practical side. Once you decide what you want, you have to qualify. And this whole process is about the insurer figuring out your risk of death.
That's all it is. Underwriting is just comprehensive risk assessment. The application goes way beyond your health history.
Right, they ask for everything.
They do. Height, weight, family health history. They want to know about causes of death for your parents, your siblings, current medications, your income, your net worth. And they look for lifestyle flags.
The sources mentioned asking about risky hobbies like rock climbing or skydiving. Yep. Even moving violations, or if you have a history of bankruptcy, anything that suggests a higher risk profile.
And then for most policies, you have to do the medical exam.
The paramedical exam, yes. A licensed professional comes to you. And it is highly invasive because they need a clear snapshot of your health right now.
So they're taking blood pressure, listening to your heart.
And taking blood and urine samples. That's the critical part. They are actively testing for high cholesterol, high glucose, checking liver and kidney function, and, of course, looking for any recent exposure to nicotine or drugs.
So why is being truthful so absolutely critical here? I can imagine the temptation to, shave off a few pounds or forget to mention a prescription.
The penalty for dishonesty is extreme, and you really shouldn't underestimate it. Lying can get your application denied outright. If they find out within the first 2 years, that's the contestability period, they can just cancel the policy.
But the real disaster is if they find out after you've passed away.
That's the ultimate disaster scenario. The company discovers the lie, they deny the claim entirely, and your beneficiaries get nothing.
And beyond just one company, the sources warn about being red flagged. This involves something called the Medical Information Bureau, or MIB. What is that?
The MIB is basically a centralized database. Insurers use it to share coded, confidential reports on applicants. Think of it like a credit bureau, but for your insurance application info.
So it's not your whole medical file.
No, it's not diagnoses, it's just coded alerts. So if you apply to one company and omit a prior heart condition, for example, that info gets reported to the MIB.
Ah, I see.
Then when you apply to a second company, they'll see that alert, realize your new application contradicts the MIB report, and they'll deny you for failure to disclose. It prevents you from shopping around with a dishonest application.
So it's essentially a credit report for your health profile. The sources even suggest you can and should request a free copy of your MIB file to check it for accuracy.
Absolutely. Checking that MIB file is a key step in taking control of your premium.
Okay, so if your goal is the lowest possible premium, what are the specific steps you can take that directly impact that underwriting decision?
You want to focus on the controllable factors. First, lifestyle changes. Start with quitting nicotine completely. Being a non-smoker means the company assumes they'll collect premiums for years longer.
Makes sense.
Losing weight can lower your blood pressure and cholesterol, and your driving record matters. Too many speeding tickets suggest risky behavior and can bump you into a higher rate category.
What about the structure of the policy itself? What can you trim there?
You need to review the optional provisions, they're called riders, that can really increase the cost. For instance, the accidental death benefit rider. It pays out extra if you die in a certain kind of accident, but it raises your premium.
And the waiver of premium rider, which covers your payments if you become disabled.
Another popular one, but again, it's an expensive add-on. If you don't really need these, eliminating them is a fast way to lower your premium.
Any administrative savings to be had.
Yeah, look for simple discounts. You can often save a bit by paying annually instead of monthly. And the sources mention looking for bundling discounts if you use the same company for your auto or home insurance.
So what if, after all this, you're just denied coverage? Or the rate they offer is totally unaffordable?
You still have options. First, ask the company why you were denied. Second, you could apply for a no-exam policy, but just be aware they are more expensive and offer lower coverage amounts.
And the third option?
The best fallback for many people is group term life insurance, which is often available through your employer and usually doesn't require a medical exam.
So a quick recap of the key takeaways for you. Term life is generally the best choice for predictable, affordable income replacement, period.
Right. And permanent life has that complex, costly investment piece that for the average person is just financially inferior to investing the difference yourself.
The ultimate calculation is just matching your coverage duration to your financial needs versus the cost.
Exactly. And by understanding the underwriting process and the MIB, you gain the power to influence your premium through lifestyle changes and by being smart about your policy design, especially by trimming those expensive riders.
Okay, a final provocative thought for you to mull over. If you buy a policy and later your health improves significantly. Say you quit smoking for 5 years, or you lose a lot of weight and your blood pressure normalizes.
Hmm.
The sources suggest you should contact your insurer and ask to be reevaluated. This means your initial premium isn't necessarily a lifelong verdict. It's a dynamic checkpoint on your financial risk that you can actively work to lower, potentially locking in a better rate years after you first applied.